Welcome back, legends. I'm Dr. Cal. Let's get right into this key market update video. This is the daily chart for the S&P 500. We've had a number of key pullbacks and corrections, and the key differentiator between putting in a major bottom like this and smaller bottoms with counter rallies like these is if we break above this key resistance trend line or whether we fail to do so. Why do I have a big old red flag in here? It's because the catalyst that caused this entire sell-off a couple of weeks ago is now back on the radar. I'm not saying that the same risk is back. I'm saying that the report that caused this sell-off, we're going to get an updated report before the market opened today. This major sell-off was caused, in fact, by a weaker than expected jobs report. Let's go and take a look. This was August 1st. This was August 2nd. Let's take a look at the economic calendar, August 1st and 2nd. Here's what happened. August 1st, we had initial jobless claims, kind of in line, not that big of a deal. Manufacturing PMI came in below expectations. That was the first key signal to watch. And then Friday, we had non-farm payrolls coming in majorly below expectations. The economy added half as many jobs as the market was expecting. Then unemployment rate came in at 4.3%, significantly above the consensus and triggering what is known as the SOM rule. This is the SOM rule chart on the Fed website. Here's the definition. SOM recession indicator signals the start of a recession when the 3-month moving average rises by half a percentage point or more relative to the minimum of the 3-month average from the previous 12 months. Basically, it looks at the rate at which job losses are accelerating when we meet a specific cutoff point. It usually signals the beginning of a recession. Going back to the 1970s, the SOM rule has a 100% accuracy rate. A 100% accuracy rate going back to the 1970s. So that's really what caused this entire freakout, this entire sell-off. Weaker than expected jobs reports, unemployment more than expected, the non-farm payrolls coming in below expectations. So what do we have coming up? Well, we have coming up two major key risks. Today, before the market open, we'll have retail sales and initial jobless claims. So key economic numbers that would give us an indication of a recession. That is retail sales. The previous month was 0% growth in retail sales. Forecast is 0.2%. Consensus is 0.3%. If this number misses and the initial jobless claims rise more than expected, then expect a jolt of volatility to come back into the market. After that, we have a bunch of Fed speakers, right? Fed Musallem speaking and Fed Harker speaking. Friday, we'll have Michigan consumer sentiment. Another key market sentiment indicator. So two key risks to watch. That is initial jobless claims and retail sales today, Thursday, before the market open, and tomorrow, Friday, Michigan consumer sentiment and building permits. Building permits, not that big of a deal because as the Fed cuts rates, demand for more housing will rise again as mortgage rates decline. Michigan consumer sentiment important, but today, the big number to watch is the initial jobless claims and the retail sales. The expected move tomorrow for the S&P 500 is $4 in either direction. That means roughly 547 for the upper expected move and 539 for the lower expected move. Very tight. It is getting surprisingly tighter and tighter as volatility exits the market. So we also have to keep in mind the two standard deviation upper and lower expected moves, and that's going to be $10 in either direction. Personally, I don't expect a move this big out of a report like retail sales or initial jobless claims. They are market moving reports, but I don't expect a move that big out of this kind of report. It's not like unemployment or inflation or anything like that. So more likely than not, we will continue to trade within this range, well defined in the low end by these tags of support, well defined in the upper end by these rejections and resistance. I talked about this range in yesterday's video. Go and watch it for more detail, but it is this range, 547 as resistance, 538 as support. I'm still bullish, and I'm still looking for the market to rally to the upper edge of this range. The way to trade a report like this, in my opinion, is that if the market actually sells off in reaction to the report and goes back down to the bottom of the range, I think this is going to be a buying opportunity for a rebound back to the upper edge of the range. Otherwise, I'll be continuing to hold my long positions. I am long a specific name in the market, and I plan to exit that position and take profit as the market rallies to the upper edge of this range. If we get a dip instead, I'll be adding and not selling. Now, another sign that tells me a rally, a continuation to the upper edge of this previous range is likely, it has to do with the daily chart of the S&P 500. We have this very clean cut resistance line rejected once and twice, and we will likely rally all the way to tag this resistance line before rejecting again. And what do you know? This resistance line corresponds exactly with the upper edge of this range. So again, resistance line indicating we will likely rally to the upper edge of the range before a significant market move to the downside presents itself. This is the example that I like to point to every now and then. We had a 3-month correction. This top occurred in July, just like the recent market top here in July. We have bearish seasonality in election years in October and September, indicating that yes, we will likely continue to see a correction in September and in October. And as a result, I'm treating this rally as a counter rally to the upper edge of the resistance line, just like these previous rallies. And that's when I plan to take profit and position myself defensively for a move back down to tag the lower edge of this major trend line sometime in October before the election in November. After the election, the markets tend to be very seasonally bullish. So a quick summary here, rally to the upper edge of this range is likely, even if we consider a resistance line like this. Look at that, very likely we continue to rally until we tag this resistance line before the market moves back down. If the market pulls back before that happens, that pullback should be considered a buying opportunity for a bounce back higher to tag this resistance line. After we realize this target, I'll be exiting my long positions, positioning myself defensively. I have a couple of defensive names that I really like that I always discuss in the Discord community. You can check those out if you're interested by joining our trading community on Patreon/MoneyTimeMachine. The link will be in the description box below. So that's my outlook as of right now. If we take a look at something like the VIX also has realized our downside target back to the bottom of this range. This tells me we're probably a day or two away from the market putting in a local top, the VIX putting in a local bottom, and a second volatility spike coming in, giving us a pullback or something more serious than a pullback. The ratio between consumer discretionary and consumer staples, that is risk on versus risk off sectors, offensive versus defensive sectors, bullish versus bearish sectors. The ratio chart actually declined yesterday. This tells us that the market is getting a little bit nervous ahead of these couple reports. However, I still expect the ratio chart to rally all the way back to the bottom of this prior range. That means still more upside ahead for stocks like Tesla and Amazon before a bigger pullback presents itself in the market. I'm trying to keep this video as short as possible. I'll come back with another market update, hopefully in the next couple of days. But a quick summary, everybody. A rally continuation to tag this resistance line likely, then a pullback. If we get a pullback before that happens, that pullback should be bought. So if we get something that looks like this pullback should be bought for a counter rally back to tag this resistance line. If we tag it today or tomorrow, that will be the take profit level at which I'll be exiting my long positions and looking to position myself defensively for a more meaningful drawdown in the markets, and a rotation out of risk on offensive bullish assets into defensive bearish sectors in the market. If you like this type of content, please consider supporting the channel by joining the trading community on Patreon. Obviously, you don't have to, but if you do, I thank you for your support. Another easy way to support the channel is to smash that like button, subscribe, turn on the notification bell. If you watched till the end and you enjoyed the video, smack that like button right in the face. If you did not enjoy it, I do thank you for your time and attention. That's all I have for you today, legends. Thank you so much for watching, and I'll catch you in the next one. Bye-bye.
Oh, wow. Oh, wow.